Well, good evening, everyone, and welcome to our YouTube live that we do every 2 weeks. And let me start this week by saying that I'm on a diet. So I may pass out from lack of calories at some point. Teddy's joining me here. He's very enthusiastic. He's wagging his tail. He knows that he usually gets a treat during these sessions. So you heard the word, didn't you? Yeah. So this is your chance to ask questions and my chance to answer them. And the usual procedure, so we'll have an hour. We'll finish at 8 p.m. UK time. And if you're one of our YouTube supporters, then we'll see a little crown next to your name and you'll get pushed to the front of the queue when it comes to answering. And if you do a super chat, again, you'll get pushed to the front of the queue and we'll answer you first. And I can see we've got one of the Patreon supporters on already, and Michael's kindly joined us as well as one of our supporters just now. Michael Collins, thank you very much for that. And so let's get started. We'll start going through the questions, and I better just get some treats ready for Ted because otherwise it's going to get ugly. So this is his treat bag, and we'll take 2 of these out. Right, so first question. I'll tell you, that's so lazy. You're going to stand? You're going to stand? Very good. Well done. For the first question is on Slack, and the first question is, from Dave, who says, you suggest a global index avoids the difficulty of making regional predictions, but as the US makes up most of the global market, will this be an implicit bet on the US continuing to outperform? Yeah, I guess. I guess the thing about global indices and market cap weighting is countries which have been successful in the past tend to be successful in the future. This kind of success of turning earnings growth into price growth is something which doesn't come and go quickly. And that's why I expect that the US will continue to do well. It may not be the best region, but it certainly will be one of the best. I'd be very surprised if that wasn't true. You don't take that kind of technological advantage and lose it in the matter of, a few years. So I'm not particularly worried about the US underperforming massively. I am concerned about the concentration risk in the United States in tech, which is pretty extreme. In China as well, it's getting quite extreme. If you look at the market cap weighted version of China, then you'll see that companies like Tencent, Baidu, they account for a large proportion of the index. So that is a concern, because if something happens with those companies, either tax reforms globally, which is actually looking quite likely, that's certainly something that's been discussed by President Biden, and also the idea of antitrust laws where a big company could get split up because it's not competitive to have such huge companies which are so dominant. That could have a significant impact on those mega caps, because they are obviously in the firing line when it comes to tax reform and also splitting up monopolies. So I'd be concerned about that. So I wouldn't be too concerned about having a market cap weighted index. And if you are going to go underweight the US, the risk is that you'd underperform because the US will carry on outperforming. So I'd say it's split either way. So, I wouldn't be that worried about a global market cap weighted index. And certainly for my portfolio, that's what I'll probably be buying. The second question, also from Dave, is, would splitting equally across regions be a more agnostic position? It depends on your definition of agnostic. I mean, one of the reasons why we market cap weight is to do with liquidity. And if you look at the first indices that were created by Jack Bogle, actually it was before Jack Bogle. If you look at the first indices, they were equal weighted. It was an equal weighted S&P index. And it was just impractical because they had to buy lots of tiny stocks, which were very illiquid. And as the relative weightings of those stocks changed from month to month, they had to buy and sell very illiquid stocks, and the trading costs became prohibitive. So the reason why we market cap weight is because large caps are cheaper to buy and sell. If you look at the bid offer spread, the difference between buying and selling price, it's almost directly proportional or directly inversely proportional to the size of the company, the logarithm of the market cap. So just bear that in mind. Market cap weighting is a practical weighting because it reduces trading costs. So if you're tracking the index, market cap weighting makes a lot of sense. In the case of equally splitting across regions, what might make more sense is weighting proportional to gross domestic product. Now that would give too much weight to China, unfortunately, and countries like India, so it would have a huge tilt towards emerging markets. But splitting equally across regions, yeah, I guess you could. I guess you could do that. Or even choose your favorite country from each region, maybe. There are various ways of doing it. You could also go for price to earnings multiples, so look at the CAPE ratios for each country. I know that for a fact, Meb Faber has back tested a kind of CAPE strategy by country, and he finds it does very well. I don't know what the holding periods are or the look back periods, but people in the community have told me that he's published stuff which says that that's a good strategy. So there's certainly not just one way of doing it, but equally split across regions, yeah, that might be one way to go. Moth says, hi, Ramin, how would I evaluate TIPS, US government bond, as a first-time investor? So just in case you don't know, TIPS stands for Treasury Inflation Protected Securities. So these are government bonds where both the principal, so let's say you lend $100 to the US government by buying one of these TIPS, and it's a 10-year bond. In 10 years' time, you don't just receive your 100 back, you'll receive $100 inflated at the rate of inflation between the time you bought and the time you receive your capital back. So if inflation cumulatively has increased fourfold the value of your bond, then you'll get $400 back over that 10-year period. So not only the principal is inflation linked, but so are the coupons. There is a little bit of a lag, but as inflation increases, the coupons that you're paid will also increase in line with inflation. So that's what a TIP is. That's what a TIPS bond is. Now the key thing to understand is the break-evens for TIPS. So let's have a quick look at those. And in fact, the next video that I'm about to do on YouTube is going to talk about inflation. So let me just quickly share my screen so that you can see this. And yeah. Or actually, let's go to Fred. Whoop. And we'll look at the 10-year break-even. So what this tells you is that at the moment, the 10-year break-even is 2.33%. So in order for this to be worthwhile, in other words, if inflation is going to be greater than 2.33% over the next decade, you'd be better off buying the Treasury inflation-protected security than you would buying the regular government bond. Or if we go for the 5-year break-even, I think that's slightly higher. Yeah, so the 5-year break-even is 2.56%. So what this is saying is that if inflation is more than 2.56% over the next 5 years, you'd have been better off buying this TIPS than buying a regular 5-year treasury. So those are the things you've got to consider. Is your view that the Fed will allow inflation to run at above 2.56% for the next 5 years? Because it will have to average more than 2.56, because currently inflation is less than 2%. So it'll have to exceed 2.56 for at least some of that time, and it'll have to average 2.56. So probably it'll have to go up to about maybe even 3% for some of that time, and the Fed will have to do absolutely nothing. Or at least what the Fed does has to be ineffectual. So personally, I think, that's a fairly unlikely outcome. I personally don't think that would be worth it at the moment. So, but the key thing to understand is that TIPS give you a hedge if you get unexpected inflation. And what the break-even will tell you what's expected. That's all I'd say. So if you're going to buy them, that's what you want to consider. And what TIPS also give you exposure to, risk that you may not want, is inflation risk. Is yield risk. So if interest rates increase, just like a regular bond, TIPS will lose value. So it's no different from a regular bond in that sense. You've still got exposure to rates, and you may not want that. So just bear those things in mind. And then you can choose your duration accordingly. If you go for the 5-year TIPS, you get less duration risk. If you go for the 10-year TIPS, you get more inflation risk. You get more yield risk, interest rate risk, duration risk. So, just choose whichever you're more comfortable with. If you think interest rates are going to go up, then you'd go for shorter duration. If you think real interest rates are going to go down, you'd go for longer duration. So that's the way to think about it. But you get inflation protection with both. Right. So back to the question.
Like and share.
Yes, like this stream, please, because it helps us, and it would be great if you did that. It's very easy to do. You just press the like button, and it makes a world of difference to us, and it's very easy for you. Even if you're watching in playback, it helps us if you like it than if you don't. So please do that, and share it with your friends. Tell them that we're live, and tell them to join us. You can always share the link for this stream, and then they can join the party, as it were. Brilliant. So let me just switch to next question. Next question is from Carl Jung. I love your philosophy. Very good. I'm concerned about the bond market. My Vanguard personal advisor recommends 50-50 ratio of stocks and bonds, BND and BNDX, for me in retirement. How do you feel about the bond market? Well, let's take a look at those bond funds, because it's kind of interesting. Saying that you have exposure to bonds is a very general statement. Bonds are very varied, and in particular, the kind of bond is different. The regional exposures are different. So let's have a quick look at BND, just to take a look at what exposure it gives you. Here we go. So this is the total bond market ETF. And this is fairly sedate. This is one of the ones I talk about in my weekly market roundup. And the prices don't tend to be very volatile from week to week. And you can see the reason for that here. Firstly, it's on risk level 2. And it provides you broad exposure to the taxable investment grade dollar-denominated bond market. But it excludes inflation protected and tax-exempt bonds. And it's obviously got investment income because it gives you corporate bond exposure, and the fees are fairly low. So the fee is 0.035%, so incredibly low in terms of expense ratio, about 4 basis points. And if we look at the actual portfolio, we can see that the bond style is medium duration. So you're taking kind of an intermediate duration risk. So if interest rates go up, you will lose some, but you won't lose a lot. And if we look at the quality, it's treasuries, very little investment grade, and nothing sub-investment grade. So that tells you the credit quality. And if you look at the credit quality breakdown, you can see that there's a tiny bit of slightly dodgy credit. So this is just one notch above junk, is 16% of the fund. So these are corporate bonds which are one notch above junk, but most of the rest of it is AAA. The government, of course, the US government is AAA. And if we break it down by type, a lot of government mortgage-backed securities, 21%. These are the corporate bonds. So fairly unremarkable, I'd say. Not very risky either. So yeah, I mean, I think that gives you broad bond exposure. Of course, the US bond market's the biggest in the world anyway. So, you know, you're not really taking a huge amount of risk by being US only. So at the moment, will interest rates carry on increasing? I think they probably will. Obviously, we've hit a bit of a hiatus in terms of yield increase. We've gone from, again, you know, let's quickly look at that. Let's look at the yield increases recently, because it has been quite spectacular. Let's go for there we go. So back to Fred. And if we look at the 10-year government bonds, constant maturity rate. So this will give us the 10-year treasury rate. And we've gone from something like 0.5% in August all the way up to 1.7 recently. But you can see that after that, it's kind of fallen to 1.6. So this sell-off that we had in treasuries, although it was very sharp, I think people kind of got ahead of themselves in terms of inflation expectations. Inflation simply hasn't materialized at the rate at which people expected it would. Maybe it's also baking in some growth expectations, which again haven't materialized. But what I expect will happen is we will get those growth expectations realized, which means that we could have another leg higher, definitely to something around 2%. I think that would be very plausible, which is where we were before the pandemic. And if things look really good in terms of growth, if we do get 7% plus growth in the US, then I think we could be looking at, say, even 3% for US Treasury yields, which is where we were at the end of 2018. So yeah, I think we could get another widening of, or increase in yields, but at the moment it seems like we have stabilized. And I suspect we'll probably stay here until we get some confirming evidence that inflation's increasing, or that growth has actually improved. So I wouldn't be that worried at the moment about having treasuries or government bonds in my portfolio. I mean, I have a lot of them, and I made some losses as yields widened, but you know, I bought them a while ago, so the round trip for me hasn't been too painful. And I'm still holding them as a hedge in case equity sells off, and then I can use them to buy equity. So I kind of don't hugely disagree with your Vanguard advisor. Right, second question, I guess, about bonds. Oh no, we're on to house prices. Right, so I'm buying a home. This is Carlos. I'm buying a home. I'm buying a home in the fall of 2022. Better to keep a saved down payment in cash or bonds, and if so, what kind? Aim to preserve principal, but also earn some interest appreciation on the DP, on the deposit, I guess, until ready to buy, on the down payment, until ready to buy. Well, I wouldn't take huge duration risk in case yields do increase further or we get an inflation shock. Now, as part of this video, which I'm about to publish, I talk about what to expect from base effects on inflation. And Teddy, you're going to have to stand, my friend. You have to perform. You have to perform. I am. There we. Oh, very good. Very good. Well done. So in terms of safety, I'd go for short duration government bonds if you are going to go down that route. But just check what yields you're going to get if you do that. So just check whether you think that's sufficient payment for taking that duration risk. So I'd look at the yield curve. Say the yield of 10 years, well, we know the yield of 10 years is 1.6%. Just take a view on whether you think growth is about to improve or inflation will increase, because that will have a negative impact on those bonds. And if you think that is the case, then shorten your duration. And if you're really worried about rates or inflation, then cash is the choice. And particularly over that fairly short horizon, if you're going to be buying in the fall of 2022, we will see an inflation spike probably, well, almost definitely because of base effects in summer of this year. The question is whether it's then going to subside and then the shock will kind of recede. But I know lots of people will be panicking in May and June when inflation spikes above, 2.5%, because we're just not used to that. It's been so long since we had, reasonable inflation, because we just assume the Fed's in control of interest rates, and it's not going to step in probably if it is a transient spike in inflation. And that may shock some people, even though they've been very clear that that's what's going to happen. If it is short term, they will not raise interest rates. So yeah, I'd be careful about having too much duration risk. And I can't tell you what your view should be, but you need that view. Right, next question from Moth. Again, was the recent bond sell-off due to rising interest rate expectations? Yes. I mean, that's why bonds sell off. It's because that's one of the reasons why they might sell off. If people think yields are going to go even higher, then you'd get out now. So it's kind of self-perpetuating the sell-off, and it tends to feed on itself. But it's stabilized now, so I think people are kind of happy with levels where they are. So they think, if I'm receiving 1.6% for taking 7-year duration risk with treasuries, that's kind of okay. That's a lot better than it was. Much better than 0.5% for a 10-year treasuries. Everyone was joking about getting riskless, returnless risk with treasuries. Well, suddenly you're getting a return again. 1.6% for a treasury is pretty good, I think. Not great, but okay. But yeah, I think increasing growth was a driver of higher rates and also higher inflation expectations. And those have kind of been dialed back somewhat. So I think people aren't really expecting inflation to become unanchored. The Fed is still very credible. So I think, inflation expectations, if you look at many different surveys, are still around 2%, which is their target. So I'm not worried about the central bank's credibility, or at least not in the US. In Turkey, maybe. Okay, next question. Do like us. So like this stream, that would help us a lot. And let me just check how many people have liked. We've got 100 likes and 268 viewers. Usually we get about half. But if you could like, that would help us a lot, even if you're watching the replay. And you can always do a super chat, and that will help us too. And we'll push you to the front of the queue. And if you're one of our supporters, if you support us on YouTube, again, that's why we're answering all these questions first, because these are our supporters. So how are we doing? 25 minutes in, and we've got a question from Adrian Hyman, another one of our supporters. Thank you, Adrian, who says, Some forecasts show that China will overtake the US in terms of GDP by 2028. They believe that the Chinese stock market may overtake the US stock market by importance or market cap as well. That's a good question. Eventually, yes. Now, why do I say that? Well, the thing is, China is now very much geared up towards having a more deep capital market, having a less, not less centralized. It still has that unique centralized government, but it certainly wants market forces to play a bigger role in its development. And if it does have a mature capital market, remember, foreigners provide capital. Who wouldn't want that? You know, it's a great situation that people all over the world would be providing capital for Chinese companies just in the same way that they provide capital for companies like Apple and Microsoft. So I think it's a kind of no-brainer for the Chinese to want that to happen. So I think it's a matter of managing to make that happen while not changing the political system too much seems to be the game that they're playing. And ultimately, they will reform their equity market to be more transparent. I think they have to. At the moment, it's still fairly opaque, and there are questions about governance in China. It remains very much an emerging market in that sense. But I do think that it will expand to be bigger than the US market. I think that's inevitable simply because their GDP is bigger and because they have more people than the US. And that's the almost certain direction of travel for their economy. Because if you have companies which are successful, which they are, many of which are service driven, which are, you know, serving the entire region, not just China, but also China's sphere of influence in the East, then how can that capital market not grow rapidly? I think it will, and I think it'll be very successful. Will it happen in my lifetime? Maybe not. But I certainly think that the GDP is almost there already, and the markets ultimately will be too. As long as they can carry on growing their earnings, just like the US has done it very successfully, then, you know, I expect that they will probably catch up with the US at some point. But I've got no idea when that would happen. But obviously, if you buy a market cap weighted index over a long period of time, as the size of the market in China grows, currently it's 5% of global equity markets, the US is over 50, it's 1/10 of the size, but just look at the rate of growth of their economy. So I think eventually it'll get there, but not for a long time. Oh, gosh, I've got a backlog here. Right, okay. So A.G. Smith is saying, wondering about chances of US using delisting as a form of sanction. I think they already are doing that. So there was talk about some of the ADRs, the American depository receipts for some of the Chinese tech companies being delisted. I don't know if it actually happened, but certainly there was discussion of it. So it is an ongoing threat, and it is a big threat. I think it's really useful for Chinese companies to be able to raise capital in the US markets. But we'll just have to see. I think it is a threat. I don't know how serious it is, but yeah, I think they might well do that. Next question from Arsenio Penesi, who says, "Hi Ramin, if the provider of my ETF defaults, what happens to my shares? Will I manage to recover any? Should I diversify among ETF providers?" There used to be this brilliant website called, it was basically looking for ETFs that were likely to die. I think it was called ETF Death Watch. And it was great because every week you could read about, oh, look, this fund hasn't made much. It's probably going to shut. And they were often right. But hundreds of funds are shut every month, as far as I know. And all that happens is that the investors get their money back. And if you think about what an ETF is, that makes perfect sense. It is just a portfolio which you effectively own, but the contents of the portfolio are managed by someone else. That's the way to think of it. And that's the way the legal structure an ETF is constructed. You should remain the beneficial owner, and if the fund manager becomes bankrupt, it's irrelevant because the value of the ETF, the value of the funds inside it are still yours. So that's why I wouldn't worry too much about ETFs closing. The worst that can happen is that they'll have to sell the stuff inside the ETF. You'll be given cash back, and it'll crystallize a tax liability if you receive the proceeds of the sale back. So that's probably the worst case. I've never heard of an ETF where it closed down and the ETF owners didn't get their full value of the stuff inside the ETF back. It's only the case where you have an exchange traded note, which is a very different structure, where you are taking counterparty risk. An exchange traded note is like a bond. So if I were to issue an exchange traded note, you'd be taking my counterparty risk. It's like a bond, but the value of the bond, the principal, is in proportion to an index. So what I'd do is I'd agree to pay you that principal in proportion to the value of the index. But if something happened to me, if my credit quality got worse, the value of the ETN, the exchange traded note, would fall. And if my credit quality was really bad, it would fall to zero. So that really is dangerous. So just be wary of ETNs, because an ETN is very different from an ETF, because you are taking the credit risk. But certainly for an ETF, an exchange traded fund, the counterparty risk is negligible. The sponsor of the ETF is simply somebody who has to do a fairly basic job. If it's a passive fund, if it's an active fund, obviously the manager is much more important. So, for example, ARC funds are actively managed, and what do they call them? Active, non-transparent funds, ANT funds, ANT ETFs. Okay, but should you diversify among ETF providers? Certainly if they're active, I would. If they're passive, not so important. All that matters is the index that they track. And if the counterparty risk is irrelevant, then so is your concentration risk with a given provider. As long as they do a fairly good job of tracking the index, which most of them do, then I wouldn't worry too much about the manager. It's just how much you pay for the tracking. Right, please do like us, like this stream. We've got 330 viewers and only 135 likes. Please like us more, please. That would help us a lot. Right. We've got some super chats. Brilliant. So Carl says, what's your take on China's future growth? Estimated 20%. And what ETF would you recommend to invest in to capture? Or should one just do an international ETF? Yeah, I mean, not all China funds are equal in the sense that they're all equally good. Some Chinese companies, for example, until recently, you couldn't buy China A shares. These are Chinese companies which trade on Chinese exchanges like the Shenzhen Index or the Shanghai exchange. Now, those generally do better than the indices that we had before those were available. The other thing to go for is an index which excludes state-owned enterprises. Let me just show you what I mean by that. I'll go to screen share again. And so we're going to look for an XSOE China ETF. Yeah, so this one from Wisdom Tree is one example of one. And the idea behind this is that state-owned enterprises tend to underperform ones which are not state-owned. What do we mean by state-owned? If you lived in the UK in the 1970s and 80s, you probably remember those nationalised companies like British Rail and how they were a bit grim and not very good. Well, they're usually not run so efficiently as companies which aren't state-owned. That's the idea. And this index, going back to 2007, splits out state-owned enterprise companies. That's the flatlining line at the bottom, and the blue line is excluding state-owned enterprises. The idea being that if you're the Chinese government, you'll always skew the company's activities to favour the receivers of services. It's always about providing a service to the Chinese people. Whereas for a company, the first goal is to service the interests of your shareholders. Now, people may lie about that and say, oh, our employees are our greatest asset and we invest huge amounts in our employees. Not true. The employees are a cost, and if somehow employee unhappiness detracts from earnings, sure, you don't want that. But always, the whole purpose of a share and its entire legal structure is to provide the maximum benefit for shareholders. And that's always been true. It's been true since the time of, the first companies that were ever set up in the 1600s. That's been true ever since. So that's why I think it's important to distinguish between the SOEs and the non-SOEs. So anyway, you can get that in the US. I don't think that's available to UK investors, unfortunately. But that's probably the best way to get exposure to China. Yeah. So back to your questions. An international ETF is also very good. Or if you want China exposure, just buy emerging market exposure, because it may not be that China is the best performer. It may be that another country, a smaller country from EM, outperforms China, but China's probably going to be about half of any emerging market index. So it'll still give you a lot of China exposure with the potential upside from another country in emerging markets. We've got Bruce Wayne. I love your Batmobile, and I had a model of it when I was a kid. It's brilliant. And I love your cartoons and your movies. Very good. Right. Your question. Is Vanguard UK expensive? FTSE All Cap, ongoing charge 0.23%, fund fee 0.09%, platform fee 0.15%, total 0.47%. Some say index funds at 0.2%. So isn't 0.47 expensive? Can be, but really depends how much you've got invested. Because remember, the platform fee depends on whether you've hit the cap. So let's just do some rough calculations. So let's say, where is my pen? Here we go. So let's say you've got 100,000 invested. And if your fee is oh dear, didn't want to do that. If your fee is 0.0015 times 100,000, then that'll be £150 a year. So that'll be your fee. This is your fee in terms of currency which you pay, and this is the amount invested. But if you invest $1 million, then the fee would be $1,500, but in fact you only pay $375 because that's the cap on Vanguard.
I'm sure you're sharing that.
Oh dear, I better share my screen if you're not seeing that. Yeah, so hopefully you can see my screen now. So yeah, so if your fee is so the fee here is 150 if you've got 100,000 invested. If you've got $1 million invested, you're going to hit the cap. So it's only going to be 375. So 375 as a percentage of a million is going to be 0.04%. So your platform fee starts to fall off pretty quickly once you hit the cap of 375. When do you hit the cap of 375? Or you just divide 375 by 0.0015, you hit it at 250k. So every pound you invest above 250k, and remember that's across all of your different platforms, across all of your different products. So that's your SIP, your ISA, your general investment account. The combined amount is what goes towards this fee. So if that's above 250, then suddenly it starts to get a lot cheaper. But it's certainly true that Vanguard isn't always the cheapest. You know, it's always worthwhile shopping around and comparing other platforms. But what's generally true is they will be one of the cheapest. And they are completely dedicated to keeping their fees low. You've just got to visit them and talk to them to realize that's the case. It's almost like a religion with them that fees should be kept low. So, yeah. Let me just stop my share here. And go back to this. Right. So 0.47 would be fairly expensive, but you've really got to compare that with other platforms to see what you could get to see whether it is expensive. And if you have large amounts invested, the cap becomes really quite significant. But certainly things like Interactive Investor, which is another fixed fee platform, if you're only paying 120 per year rather than 375, it would be even cheaper. So that's a very competitive platform if you've got large amounts invested. Atna says, are you aware of the Vitality investment platform and how you can potentially get 0% platform fees and a 2% loyalty bonus from Vitality every 5 years? I wasn't aware of that. Let's have a quick look at Vitality and just see what they say. Let me share my screen again. Ooh. Vitality, and I will share so you can see this. Oh, a very nice dachshund, a beautiful dog. So you only have to invest £50 a month. Looks like they provide health insurance, life insurance, and investments. And let's have a look at their stocks and shares ISA and just have a look at the fees. So it's got you can get funds from Vanguard, 91 SEI. Let's have a look at the charges, always interesting. So product charge is tiered, so the more you invest, the lower the charge. That's true of many platforms. And if you choose to invest in Vitality funds, you could pay no charge at all. Oh, I don't like that. Fund charge for the ongoing management of the funds. Obviously, you always pay that on every platform. An advisor charge if you choose to take it out with a financial advisor. So let's have a quick look at the charges themselves. This is quite a schlep to find the charges, not a good sign. Okay, so what do you pay? Up to 75k, you pay 0.45, depending on which version of it you're on, bronze, silver and gold. So these don't look particularly competitive. I don't know how you get the platinum version. I assume you pay some kind of fee up front. Maybe if you take out other products. So maybe they're just trying to cross-sell you the other products, things like insurance and so on. But certainly these fees aren't particularly low. You've always got to compare with Vanguard and it's 0.15. And now you've got platforms like Free Trade and Trading 212 where the fee's effectively zero. So yeah, I don't think that's particularly competitive. But yeah, could be interesting. It's not one I've come across before. Thank you for sharing that. Okay, so hadn't come across it. Interesting. Always nice to hear about a new platform. Next question from Andrew O'Connell. Seeing AAA, AA, single A, triple B without getting post-traumatic stress disorder, what was the events that surprised you most about working in banking during the 2008 global financial crisis? P.S. What's the beef with Goldman Sachs and getting out first as usual? Okay. Yeah, so obviously I was there in 2008 when we had the global financial crisis. I think what surprised me the most was how little it affected us. So we were still getting bonuses during and just after the very large losses that the bank I was with at that time made. So I think that was surprising. And the other surprising thing, I think, was the fact that everyone was blaming banks. The level of hatred towards banks was just spectacular. Now, I always found that kind of surprising because I always consider that banking is one of the great success stories for the UK. Switzerland I was a Swiss bank I worked for. Switzerland, again, they're very good at banking. So, knocking that industry when it's one of the best things you do makes no sense. It's almost like having an incredible sports team, and yet when they come home after a victory, you actually make fun of them, you pillory them, which is ridiculous, I think. So yeah, that was the biggest shock to me, I think, which was the level of hatred towards banks. And many people blamed the banks for what was happening. But all an investment bank does is produce products which its clients will use. Now, sometimes they miscalculate the risk. Sometimes they act in their own favour. And there are clear examples where they screwed over customers. But for the most part, that's not true. Most of the people I worked with were quite ethical. And, I spoke to a lot of people at the banks. So, I know that for a fact. So I was surprised at how nice the people were at investment banks. They're really nice people, very intelligent for the most part. And I had a great time. I've got to say, I really enjoyed working in investment banking. My point about Goldman Sachs is they always get out when they're always the first rat to leave the sinking ship if there's a problem. So Greensill is one example where they closed out their position first, and the bag holders like Credit Suisse were the last to close out their positions and made the biggest loss. So that was fairly typical. The same thing happened with the subprime crisis. They did take a hit with long-term capital management, Goldman did, along with everyone else. So they didn't get out in time for that one. But I think for things like Bernie Madoff, they didn't. I don't think they had a hit from him that was big. But they certainly seem to be very good at getting out of the way of scandals first. So that's all I was saying. Right, next question from Gary. We've got 10 minutes left. Please like us. Please like our stream. Let's look at the numbers. So we have 370 viewers, 177 likes. And so please do like us. Please do like the stream. Tell your friends about it. There's still time for them to join us and ask their own question. And please do super chat, because then you'll get pushed to the front of the queue, because we've still got a fair number of questions from people who have been supporters, because supporters also get pushed to the front of the queue by Laura, who's diligently putting these questions on Slack for me. So Gary, Gary says, do you think your model for forecasting gold price also needs to consider recent crypto phenomenon? Also, what are potential factors that could break crypto bubble? Personally, I don't know how I do that. So you'd have to look at something like flows into crypto versus gold. But I don't think the crypto market is so big yet. It's getting there. Certainly, if you look at the Bitcoin market cap, it is getting comparable with gold. But it's still not the case that it is significant, I don't think. And if people do think that gold and crypto perform the same function in a portfolio, they're wrong, because they're very, very different beasts. You can't compare something which has a volatility of 80% with something that has a volatility of, say, 15%. They're very different animals. One of them is clearly a much more risky proposition than the other. Also, gold has industrial uses, so at least it has some uses, whereas I don't think you could make the case that Bitcoin has a particular function other than speculation. Other cryptocurrencies do have reasonable credentials when it comes to things like transactions, because their transaction speeds are faster. But I don't think you can make the case that that Bitcoin is good for that. So what could break the crypto bubble? I've always said that it would be legal problems which would ultimately pose a kind of existential crisis for things like Bitcoin. All it takes is one example of a government which was threatened in some way by, say, a terrorist organization that was funded via Bitcoin, where they showed that tracking, or say, for example, some kind of pedophile ring that was funded by Bitcoin. I'm not saying that it's an inherently evil system. It's not. No, money's ethically neutral. But all it would take to turn public opinion against it, and more importantly, governments against it, would be a crisis like that. And then they could talk about banning it. So could a government ban crypto or Bitcoin? Yeah, they could. If it threatened their power over their own currency or their political power, you bet they'd ban it. So that's, I think, the biggest threat to cryptocurrency. But otherwise, I think as part of a portfolio, I don't think it's necessarily a bad thing. But I'd consider it if I could get an easier access to it via something like a fund. I'd certainly consider having it as a satellite investment in my portfolio. But at the moment, I think it's just too difficult for me to get exposure. And certainly the gold model I've got, I don't think I could include the effective flows into crypto to adjust the gold price. But I don't think you need to. I still think the drivers of gold will continue to be real interest rates and the strength of the dollar. I still think those are the two most important drivers. Right. Question from David Garth. Will a fund...
David super chat. So thank you.
Oh, David Garth super chat. Yeah. Thank you, David. Will a fund containing, say, Alibaba protect me against that stock being delisted in the US? I think if a company gets delisted in the US, that's going to have a knock-on effect on its price everywhere, simply because it'll be harder for that company to raise future capital in the US market. So I think it won't be the case that it'll protect you completely, but obviously that'll be better than actually owning the ADR in the US. So, if it is a fund, at least you'd be diversified. But I'd be really worried if I had single stock exposure to companies like Alibaba at the moment, because, with valuations being as high as they are, I think that's definitely one region which is at risk of a fairly significant sell-off. And, these Chinese tech stocks probably will suffer a lot. We've already seen them sell off significantly, and it could be quite a bit worse. So I'd probably diversify away from that if you possibly could, because single name exposure in China is quite risky. Adrian says, what's your take on Elon Musk? In previous videos you mocked him a little. I did. In fact, I said that Jack Ma disappeared, and wouldn't it be awful if the Men in Black appeared and took Elon Musk because he is a bit of a pain. But, you know, I love what he does. I absolutely love SpaceX. I mean, the guy has real hands-on knowledge of engineering. I love to see a CEO talking about engineering. That's a wonderful thing to see. The days when you could have a management that didn't know about their products and who talked about technical knowledge as if it was a bad thing, I think was awful. I think that having a CEO with that kind of vision and understanding of the engineering principles is incredible. I think that's great. The guy is an arsehole, though. It has to be said. So when you see Tony Stark in some of these Marvel videos, these Marvel films, I think that side of it, you know, the reproducing the Musk character is fairly accurate. But, you know, smoking weed on and showing the pictures, that's crazy. Shilling Dogecoin, I think, you know, why would he do that? Yeah. So some of his behaviour is a little bit dodgy, but all in all, I think he's great. And I love the products he makes, and SpaceX and Tesla, I think are wonderful. Right. Atna says, you can achieve platinum status. This is the platform we were looking at, Vitality, through their Healthy Living Points program. Worth looking into. And I'd really like to see you make a video on the platform. Are you involved with them at all, Atna? Are you an employee perhaps, or an owner? But anyway, yeah, interesting. I will take a look at it. Adrian says, as the mortgage forbearances and rent moratoriums end, will this create demand for US dollars? And would a higher US dollar have a wrecking ball effect on the global economy at some threshold? Yeah, I mean, if we see massive dollar strength, it usually comes with massive emerging market currency weakness. And it's not just the Turkish lira which is sold off. We've also seen the Brazilian real sell off, and I think the Argentinian peso, as usual, sold off. So certain emerging market currencies are already suffering. So if that dollar strength story continues, it will be a problem for some emerging market countries. And eventually it'll become a problem for the US because, you know, their exports will suffer from a very strong dollar, and it'll have an effect on their balance of payments. But I don't think it would have a wrecking effect on the global economy. But certainly when you do get a risk-off movement in markets, dollar strengthening is one of the inevitable consequences. I still remember when the US Treasuries got downgraded. It was hilarious because what actually happened was that yields fell for US Treasuries and the dollar strengthened. So it had kind of the opposite effect, because if people are scared, they still ran to the US for safety. Last question, I think, because we're just approaching 8 o'clock, from Lenin Velaturi, who says, what do you think of synthetic ETFs? Well, certainly BlackRock has changed its opinion about synthetic ETFs. So one of the benefits of a synthetic ETF is that you don't have to pay withholding tax. So if you do get dividends for the fund you're investing in, and most of them do have some dividends, then that can be really tax efficient. And over a long period of time, that could be really beneficial to you. So I think synthetic ETFs are great from that point of view. Obviously, the risk is that the ETF provider has counterparty risk with the provider of the swap, which is underlying the synthetic ETF. Now, if it has multiple providers of swaps, if it holds total return swaps with 3 or 4 investment banks, not a big deal. But if it's just one dodgy investment bank, then you might worry about that. But generally, you know, I think synthetic ETFs are a great idea. I personally don't have a problem with them. It is useful to know who the counterparty is, and some investment banks are dodgier than others. And usually it's difficult to know who they're holding the swap with. So if you knew that, I think it would be a lot better. And there's not always complete transparency with the counterparty risk, which I think there should be. But certainly synthetic ETFs are getting more popular, more acceptable. I hear less people, for example, saying, oh my God, I'd never hold one. because of the fact you get this tax benefit. So we've reached 8 o'clock, so I think we'll probably wrap it up there. It's still not too late to like us, so you can still like the stream just to thank us for the session and for our performance and Teddy's performance, although he's passed out now, unfortunately.
Mine.
And Laura's, of course.
Mm-hmm.
The unseen face of Laura here. But we can hear your voice, Laura. There we go. So thank you all for joining us. It's been great. Wonderful questions, as always. Thank you for the super chats. And hopefully we'll see you again in 2 weeks' time. And we hope we've been useful for the session and we've answered some of your questions at least. And if you do want to get pushed to the front of the queue next time, just support us on YouTube. It's very cheap to do that. And there'll be a join button under the description so you can do that. And if you want to join us as part of the community, even better. If you support us on Patreon, you get to join us on Slack, and you also get to see our library of members-only content. And you get all the jolly chats on Slack, which are lots of fun. So let me end it there. And if you want a one-to-one with me, you can always arrange a power hour, which is like this, but it's just you and I. So have a great 2 weeks, and we'll see you then at the end of April. Take care, everyone. Good night.